Good afternoon, good morning, good evening, everybody. Thank you for joining another episode of the Tower Wealth Advisory podcast series. Today, we're here speaking with some fixed income people of a topic that's pretty lively in the markets today. I'm Tyler, and this is my business partner, Dave. We're here with IA Clarington Investments, and I'm going to turn it over a bit to a partner that Dave and I work pretty closely with, Jonathan Zabala. He's our representative from IA, the vice president at IA Clarington Investments. He is our support here in the ground in Edmonton. He's been a big resource to here or for us here. And I'm going to let Jonathan introduce our speaker today. So Jonathan, maybe I'll turn it over to you. You can give us a bit of background on IA as well as some background on our speaker.
Of course. Dave, Tyler, and Justin, thank you for the invitation this morning for a joint presentation on behalf of IA Clarington with Jeff Sujitno and Wellington Square. My team and I certainly appreciate the partnership we have with you and the relationship we've built over the years with Tower Wealth and Wellington Altus. Today, I'm very, very pleased to introduce our guest speaker for today's investor webcast. His name is Jeff Sujitno. He has nearly 2 decades of investment management experience. He's the founder of Wellington Square, based out of Toronto, Ontario. Jeff and his team specializes in fixed income and credit with a focus on senior loans, high yield bonds, and investment grade bonds. Jeff is also a chartered investment manager, chartered professional accountant. He holds an HBA from the Richard Ivey School of Business at the University of Western Ontario. On a personal note, I actually joined IA Clarington about 5 years ago, and I first heard about Jeff and his mandates when I was working with different teams and when I was in a different investment management team. And it was very common to hear about Jeff's mandates and meetings, and his reputation definitely precedes him. And today, I'm very happy to say that myself and my parents are personally invested in in Jeff's mandates. His philosophy of alpha through avoidance can certainly provide investors with value today. Having said that, I'll turn it over to Jeff Sujitno.
Thanks, Jonathan. No pressure there telling me that you and your folks are invested in our funds, but thank you for the opportunity to join everybody here. What I thought might be useful in this conversation is just to familiarize everybody with what's going on in the marketplace, because we are in a very, very strange place. And what I mean by that specifically is the equity markets are down and the bond markets are down. And so you've got this situation where it seems that there's red everywhere. And what we have to do is make sense of it in order to understand how we should be positioning portfolios and also understand what benefits things like fixed income will have in that overall portfolio. So before kind of jumping into that, maybe I'll just take a second and make sure that everybody knows a little bit of Bond 101, just so that we know what we're speaking about specifically, okay? So I'm not sure that everybody knows this. I think a lot of people understand this, but the bond market is actually much, much larger than the equity markets. And yet investors know very little about bonds. They seem to know a lot about equities because there's so much press. It's covered on CNBC and Bloomberg, but the bond market is a little bit different and a little bit more cloak and dagger, so to speak, because we don't see those things trade on an open exchange. So the US bond market is about $68 trillion in size, okay? The S&P 500 is about $43 trillion. So the bond market, just in the US, is about 1.6 times the S&P. So this is a huge investable asset class, and institutions are obviously very, very invested in them. My background prior to running money for retail investors is I spent over a decade managing money for large institutional investors like Ontario Teachers and AIMCO and BCIMC, all in fixed income specifically. So when I talk about this huge asset class, I can tell you that all of these pension funds and these endowments, insurance companies, those are the big, big buyers, but so are retail investors. And I'll try to explain why this is such an important class, I think, for everybody to know. So here's an interesting fact. If you go back in time and you look at returns from 1990, the S&P 500 has returned about 11% on an annualized basis, right? This is a nice long-term return that you can take a look at and measure. The bond market has returned about 5%. Okay, so the bond market has done really well as well, about half the return of the equity market, which might on an absolute basis sound not that great, but on a risk adjusted basis, it actually is really, really great. The bond market return has been generated with much lower volatility, and that low volatility is important. And having an investment in an asset class which doesn't fluctuate as much as equities, I think is something that people look for in a portfolio. So on a risk-adjusted basis, the really important takeaway here is that the bond market gives you very strong risk-adjusted returns. Now, bonds are fixed assets or are considered part of fixed income because what they have is they have a fixed interest rate. And in that fixed interest rate, when you have that fixed interest rate, what happens is there's fluctuations in prices. Bonds do change in price, just like equities do, but they're based on fluctuations in interest rates. Now, I don't want anybody to be overly confused about this, but it's very important to understand that bonds, just like equities, trade on an exchange or trade in the open markets. They get priced all the time against the prevailing interest rate, and they move up and down. So what you can't look at is just the yield of a bond, right? You have to understand what prevailing interest rates are like. And the reason I have to explain this to you is because I want to explain to you what happened in the recent pandemic crisis and what's happening today. And I want to put all of that into context. So if you can just bear with me here. Bonds, as I said, trade just like stocks, but investors don't see these exchanges that they trade on, all right? If you take a look at the bond market itself, it's broken down into various components. You have government bonds. You have corporate bonds by companies like Procter & Gamble or Disney or General Electric. You have high yield bonds. High yield bonds are bonds issued by companies that have a little bit more credit risk, and that's why they're called high yield. They're not rated investment grade. And those are companies like American Airlines and Charter and Burger King. These are well-known names, but they are high yield names. So let's take an example so I can talk to you about how coupons work, yields work, and interest rate movements and how they impact price, okay? So let's go back in time and let's pretend that on October 31st, 2018, you as an investor bought a government bond ETF, all right? You bought this government bond ETF because you wanted to have government bond exposure in your portfolio. And that government bond ETF had a yield of 3%, okay? And you held on to that ETF for 2 years. What would your expected return have been? Well, the math seems pretty simple. You own this government bond ETF. It has a 3% yield. You own it over 2 years, which basically means you're going to make 3% in your first year, intuitively, 3% in your second year, intuitively, resulting in a 6% total return over these past 2 years. But what happened was significantly different than what your expectation was. That government bond ETF that you bought returned 19%, not the 3% each year that you thought. It returned 19. And how did that happen? Well, bonds, as I said, are very sensitive in price to changes in interest rates. And what we had between 2018 and 2020 was the pandemic, okay? And that is why you had this massive return in bonds. Between February 2020 and March 2020, the S&P fell by 34%. Over that same time period, the NASDAQ fell by about 30%. And these declines were fueled because we thought economic activity was going to grind to a complete halt. The pandemic caused people to stay indoors and economic activity was going to stop, right? That was the expectation. And as a result of that, risk assets, being the S&P and equities and the NASDAQ, being tech equities, fell significantly. So what are we going to do in that situation? The central banks had to step in, right? In a situation where we had the pandemic that nobody ever thought would happen, and you had it globally, and economic activity ground to a halt, it was mandated upon the central banks to do something. So what did the central banks do? They are responsible for handling jobs. They're responsible for containing inflation. Those are their two key mandates. So what happened when equity markets fell and it seemed like economic activity was going to grind to a halt? What the central banks had to do was they had to stimulate the economy. They had to have people continue to have an income during this crazy time. So what the central bank can do is two things. The central bank can influence interest rates, and that is the overnight rate, right? And what they did immediately after the pandemic was they cut interest rates significantly. The overnight rate, which is the borrowing rate that we all talk about, that impacts you and me. It impacts us because we borrow, we have a mortgage. It impacts business owners because business owners borrow money to fund their businesses. What the Fed had to do, what central banks around the world had to do, was they had to cut interest rates dramatically. And when they cut interest rates dramatically, that was all in an attempt to keep the economy going. And what was the result of all of that cutting? So let me talk about the specific numbers. Interest rates fell from 1.75% to near zero. It was actually 0.25% is what they cut interest rates to. Imagine what happens when your cost of borrowing goes down so significantly, right? That should really stimulate the economy. The other thing the Feds did was, because you can't only change they can only change the overnight rate. The Feds and the central banks cannot change your 3-year mortgage or your 5-year mortgage rate or 10-year rates that companies use to borrow. They can't influence longer term rates, but they wanted to push down the cost of borrowing for everybody. So what did they do? They embarked on something called quantitative easing. Okay, and this is an important concept. Quantitative easing was basically the central banks buying as many government bonds and as many mortgage-backed bonds as they could. And the only reason they did it was to reduce interest rates. They cut the overnight lending rate, which is what they can do, but in order to influence longer-term borrowing rates, they started buying bonds. And if you have a central bank that doesn't care what they're paying, but they want to buy as many bonds as possible, the impact is to push down borrowing costs. So when you look back at the pandemic and you look back and you think about how quickly equity markets turned around, how quickly risk assets turned around, it was because of the cost of borrowing for everybody, for all of us, went down significantly. The Fed balance sheet, now I don't want to get too technical here, but the Fed balance sheet went from $4 trillion to close to $9 trillion. $5 trillion is what they did in bond buying. That's how many bonds that they bought in order to push down interest rates. So the impact of a lower cost of borrowing was skyrocketing increases in financial assets. Okay, that is why in 2020, you had a hard decline in equities. You had a hard decline and you had concerns everywhere. But because the central banks acted so quickly in reducing borrowing costs, we came out the other side extremely quickly. You look back and Tyler and Dave will tell you, your equities did really, really well in 2020. And that's during a time when we had a pandemic. And the only reason we had that, and the only reason financial assets really rallied, was because interest rates were so low. Fed policy caused a couple of things. That rebound, it saved us from a recession, but there were also some ill effects when you push down interest rates so much. One of the things is it causes a huge discrepancy in those that have versus those that have not. So the wage gap, so the gap between those that have and have not incredibly widened. And that's because those that owned financial assets, those benefited from all of this. And those that didn't have financial assets like homes and portfolios, they're the ones that really, really suffered. So the other unintended consequence when you push down interest rates to near zero is what we're talking about today, which is inflation and runaway inflation in some ways. We have an inflation rate here in Canada that's about 6.7%. That was the latest print. You look in the United States, the inflation rate is at about 8.5%. We haven't seen these numbers in a very, very long time. So why is this happening? Very simple. When borrowing rates are near zero, you really, really push up a little bit of the, push up demand for sure. And prices for everybody start to skyrocket, okay? And that is where we are today. We are in a process of normalization. And just take 1 second here. In that process of normalization, the Fed has to deal with inflation and runaway inflation. The problem is they've been very, very slow to move. There's a lot of talk at the Fed that inflation was actually transitory, when what we're seeing is it's not, okay? So what happens in this situation? The market fully understood that the Fed, central banks, the Bank of Canada, the Federal Reserve in the US, the European Central Bank in Europe, globally, all of these banks that pushed down interest rates in order to save us from the pandemic now had to reverse course. And you saw the impact of that in 2022. That's why equities are down. That's why bonds are down. It's just we're heading into a normalization of interest rates as central banks remove all of the stimulus that they provided in 2020. Okay, so that is exactly what we're seeing. The 10-year Treasury, which is a benchmark rate and what people take a look at in terms of borrowing costs, 10-year US Treasuries went from 1.5% at the start of the year to about 2.9% today. And as a fixed income investor, I'll tell you, that is a huge, huge move. And when you have a huge move in your cost of borrowing, valuations have to come down. That's why the S&P is down. That's why the NASDAQ is down, because valuations have to recalibrate for that higher cost of borrowing. Earnings seem to be okay. High inflation suggests that revenues might be higher at a lot of companies. So it's really not the earnings yet that people are concerned about. What they're concerned about is that the valuations of things like real estate, right? We can talk about real estate ad nauseum and what's going to happen to the real estate market with higher borrowing costs. But what you saw very quickly is changes in financial assets, okay? Because of central bank policy that's changing. The overnight rate in Canada has just been increased. Everybody knows that. The US has another meeting on May 4th. On May 4th, it's likely that the US central bank will increase by 50 basis points. That's what the overnight market suggests. And so we are all going to face higher borrowing costs, ourselves as individuals, as investors, companies that borrow, we're all governments that borrow. Everybody's going to have to do so at higher interest rates and higher costs. So that will affect returns, obviously, in equities and bonds. So the Federal Reserve, the European Central Bank, the Bank of Canada, they're all normalizing rates in order to have some firepower for that next eventual but certain downturn that we're going to have. Imagine if the Fed didn't increase rates right now and they kept it really, really low and there was another recession. How can they lower interest rates more than, at the end of COVID, at the end of the sell-off of COVID, lower than 0.25%? It's hard to believe that you could do that. And so one of the things that the central banks is doing is it's reloading its ability to fight off that next recession. So what does that all mean to us today? Here's the one takeaway that's very, very important. When recessions happen, and we're all going to have to be interested in this because we all have money in portfolios, history has consistently shown that recessions happen when the central bank over tightens. They make financial conditions too tight. Borrowing costs have gone up way too much. And as a result, the economy slows down. Okay. That is a risk that I think is real. And that is a risk that I think we should prepare for. That eventual recession that will happen will cause the Fed, the Bank of Canada, the European Central Bank to pivot and start to reduce interest rates once more. And when that happens, your bonds are not going to return just the yield on the bond, but they're going to have huge capital appreciation because interest rates are going to come down. So why do you have to have fixed income in your portfolio? Point number one, you have to have fixed income in your portfolio because inevitably the Fed will over tighten and you're going to want to have fixed income exposure in your portfolios because you want to protect against those drawdowns in equity. One of the tenets of owning fixed income is its negative correlation to equities. So as equity markets go down, bonds tend to go up, right? We're in an abnormal time right now, so it's not happening. But that traditional relationship, equities go down, bonds go up, I think will hold true once we normalize. So that negative correlation is what you want in your portfolios. Bonds will protect drawdowns in your equity. Number two, as the Canadian population and investors age, one of the things they're not looking for, that they're looking for, is stability of earnings and predictability of earnings, because you don't know when you're going to pull capital from your portfolios in order to service your needs. People that are getting older need to protect portfolios so they have that surety of income. And that is what fixed income is for. And that's why that low volatility I talked about previously is so important to investors. The other benefit today, I think, of higher interest rates is that yields overall are going up as well. So as yields are going up, let's say that the recession doesn't take place next year. Let's say that recession doesn't happen in 2 years. At least as a fixed income investor now, you're getting paid a lot more than you were before when interest rates were near zero. So if you're getting paid more now, it's okay to wait. Maybe that recession doesn't come, and we don't think it comes right away. We think it will take some time because the consumer is quite strong and there's a lot of, the savings rate is extremely high. So during that period of time, fixed income is increasingly attractive today because yields are higher, right? So in addition to those fundamental tenets being negative correlation to equities, that other tenet of low volatility, you have the fact that yields are higher. So I think all of those things combined make fixed income incredibly attractive today, despite the fact that that normalization will cause a little bit of volatility going forward. So that's what I'd like to say about the market in general. So one of the things that I want to leave you with is this, because we get this question all the time. It's not just from Tyler and Dave, but we get questions around, well, Jeff, what do we do in a situation like today where there's a lot of volatility in interest rates? How do we put together portfolios in fixed income that will actually be okay in this type of environment? And so our best idea, and let me go back just for a second. Wellington Square, the firm that, not to be mistaken with Wellington Altus, but Wellington Square, which is the firm that I'm a member of, we manage only fixed income. We don't manage any equities. And the fixed income that we managed is primarily focused on credit as opposed to government bonds. We manage a little bit over $2 billion in capital. And what I can say is when we get asked, and we get asked all the time, where's the best spot to be in fixed income? Our answer is we like fixed income or fixed income categories that have floating rate coupons that go up when interest rates go up. We like them for two reasons. Reason number one, we like them because as interest rates go up, we're going to get more interest, right? It's like being a bank that lends you as a borrower a variable rate mortgage. you probably don't mind being a bank right now that lends on a variable basis to your ultimate client, because as interest rates go up, we can reset our interest rates at a higher amount and generate more income. So we like that. So we like floating rate instruments. Number two, because floating instruments actually increase, the coupons increase as interest rates increase. You don't have that sensitivity to changes in interest rates, which means your price doesn't go down, right? So that's the asset class that we like. And specifically, what asset class we like? We like bank loans, okay? Canadians are not very familiar with the bank loan category, but bank loans are about a $1.3, $1.4 trillion market size, okay? Canadians aren't familiar with this asset class because in Canada, the banks have all the, or originate loans, and they don't make it available to institutional investors. What they do is they keep it for themselves. We have access to bank loans because we run mandates that, and we access the market through the US. In the US market, banks like Bank of America or JP Morgan or Citi, what they do is they originate loans, let's say to Burger King. They originate a bank loan to Burger King. They price it with a floating rate coupon, which is very, very nice. And what they do is they keep half for themselves and they make the other half available to institutional investors like ourselves. And then we create a portfolio of these loans. And again, why do we like that today? Because people want floating rate instruments in order to benefit from higher rates and to have very little movement in price as interest rates go up. So that's an area that, when Dave and Tyler ask us all the time, what space and where, Jeff, should we go specifically for our fixed income? We like floating rate instruments. And there are other examples of floating rate instruments as well, but our highest conviction comes from that particular market. So what do we do today with what's happening in the world? I tried to make sense a little bit about what's happening in the world. The central banks will be incredibly hawkish. But certainly what's going to happen is that as interest rates go up, there are areas you can go to protect your portfolio. But let's all watch for, and let's all understand we have to have a diversified portfolio to take advantage of the fact that inevitably the central banks will over-tighten, cost of borrowing will go up too high, and the economy will slow down. Guys, I'll turn it back over to you if we want to go over questions.
That's great, Jeff. It sounds like a bit of a catch-22. They're raising rates just so they can lower them in the future, and they're going to raise them and cause a recession so they can lower them. It's almost like, well, why are we going to raise them to begin with?
We've done it, Tyler, we've done it so many times. That's exactly what happens.
Yeah, no, it's definitely our history.
Is there any politics involved in this? I mean, who gets the blame for it, right? When inflation runs hot, people riot a bit. They get angry about the cost of living, things of that nature. And then if, we bump rates, then those who have debts end up paying more of it and inflation is curbed a bit. So who benefits on either side? Who benefits if inflation's high? Who benefits if interest rates are high? From a consumer point of view.
Well, certainly nobody likes runaway price increases for things. You want to keep, you want to be able, I really do feel bad for people with lower incomes that go to a grocery store right now and have to seriously cut back on what they buy because food inflation is out of control. That's certainly not a good thing. And that's why the central bank's mandate is to make sure we prevent things like runaway price increases. And inevitably, in the short term, what you have to do is you have to increase rates in order to prevent, these prices from spiraling out of control. And what you're doing effectively by increasing borrowing costs is reducing demand to some extent. The problem that we have here today, guys, is there's still some supply chain disruptions from COVID. And those disruptions in the supply chain means that we have a supply problem. And that, unfortunately, are things that the central bank can't directly tackle.
Yeah, that was one of the questions I noted here, just listening to your comments, Jeff, was, a lot of the reading that Dave and I have done have been around, is inflation truly what we naturally and normally see it being driven by? And some of the reading we've done is that it is heavily driven right now by supply chain problems, just the hangover of COVID-19 and the shutdowns that we had to deal with. We're still trying to work through that.
And the large volume of savings people have amassed over a couple of years, and they're chasing down some of the same goods, driving prices up.
Yeah. And the way we think about the marketplace is that those savings will start to get depleted when costs increases. So as those savings get depleted, also for servicing higher costs of borrowing, we're going to find ourselves in a position where the consumer is going to have to tap out. And at that point, that demand inflation that starts to come down and demand overall that comes down have to work their way into company earnings, in our view. And that's why when the Fed over tightens, the economy, unfortunately, has to slow down.
Switching gears a little bit, you talk about recession, and that's obviously in our future at some point. There's some predictions out there as to when a recession would occur, and maybe you can enlighten us to what your predictions are. There's a lot of people that refer to the yield curves and them inverting. Do you guys have any predictions or things that you lean on heavily when looking at what a future recession is or when it's coming?
First, let me tackle that yield curve one, because that one's a little bit easier. The yield curve did invert for a nanosecond, and that was maybe 3 weeks ago. And it literally inverted for a nanosecond, and then it shot back up quite a bit. We're not watching the 2-10 spread in the US that closely. We are watching the 3-month 10-year, which is something that we think is maybe a better predictor today of a possible recession, and that is nowhere near inversion. And so we're not overly concerned yet, but we are watching for things. The recession call is the toughest call generally. And that's why you always have to have these diversified portfolios, because it's almost impossible to predict exactly when it happens. Our base case and our house view is that we probably feel the starts of a slowdown sometime in late 2022, possibly the fourth quarter. And what we're going to do is look for leading indicators, not necessarily lagging indicators like employment numbers and new jobs data, or not the payroll data, but we want to look at more forward-looking items such as PMIs and seeing how PMIs do. The Philly Fed came out today, and they have a good forward-leading indicator, and it missed expectations. So we're watching things like that, but I think we're still a while away.
That's good.
Yeah. So when you think about, for us, I mean, the way we manage, we have a basket of equities, we have a basket of fixed income, we have a basket of alts, and probably, pick one of our average portfolios that we have a lot of clients in. I mean, things just have gone sideways for 6 months. Whatever equity gains we've had have been offset by some reductions in the bonds, obviously, just because of interest rates starting to move. So, for us, we don't think there's much of a change that you can make in a portfolio other than, picking your equities better a bit, maybe even in the fixed income, like you said, a bit more floating rate, things of this nature. I think, clients get upset when markets go sideways, or when they get a negative return in a short period of time in their fixed income. They're always like, well, I never signed up for this. This isn't what I thought I was going to get with fixed income. Although it happens, a negative return of fixed income once every 10 years on average. It's kind of tough to keep people focused on their positions when they get a negative return in something they don't feel they should. And I know some of our clients watch these webinars, so I'm not berating any of our clients, but they're very good at looking, back only 1 year when they forgot, how much money they made in bonds 3 years ago, as you said. So it's this average return, and it's just the impact is large right now because nothing's moving. You're getting a bit of gain in equities, you're losing it in your fixed income.
Well, let's frame kind of what's happening today. What's happening today, if you just take a look at just one index. Let's take a look at the US Treasury Index. The US Treasury Index has experienced a drawdown currently that is more than it's ever had in the past 50 years. So what we're experiencing is completely abnormal. But the gains that we made in fixed income when interest rates were going down to near zero were very abnormal too. So I think one thing investors should be mindful of and remember is that this is a very long-term game we should all be playing as opposed to a short-term game. But also, let's not forget how good it was in the past number of years. Like, it's not normal for equities to return 20% plus. When the long-term average, as I said, since 1990, the long-term S&P return is 10%. So we've had how many years here of 20% like returns? Unfortunately, that's not normal. But it happens when you push borrowing costs to near zero. And now we're just going the other way, where borrowing costs inevitably have to go up. And it's okay, because at some point, these higher yields that we're getting in fixed income are going to be a lot more attractive. What I think is challenging, and what I think people have to understand, is your alternative, let's just say, is to go to cash or to go to a GIC. If you go to cash or a GIC, that is your guarantee of actually making a negative real return. Because a GIC in cash doesn't cover the fact that inflation's at 7%, right? And so you have to be mindful of that. Real return matters. And I think investors understand that.
Can you make a comment on, you think back to the financial crisis in 2007 to 2009, the size of the debt market today compared to back then?
Yeah, well, it's certainly the size of the debt markets have grown since the financial crisis. But I think the things that caused the financial crisis, let me back up here. If the question really is, Dave, about defaults and people losing money, I think that certain things happened during the financial crisis that aren't happening today. Like, the financial crisis was really caused by the subprime mortgages and people falsifying, mortgage applications, and that became rampant. And they were being packaged up in securitizations, and those securitizations were being sold with underlying assets that were not worthy, and were not credit worthy. That's not a situation that's happening today. Despite that, of course, the credit markets and the debt markets have generally grown. But I don't think that the default concerns that you had in 2008 are in existence today. Like, one of the last, and we're credit investors, so we're always mindful of default risk. And right now, our view is defaults will remain low, and it is not one of our top concerns at this stage. There's still despite the fact that the Fed is increasing interest rates, there's still a lot of liquidity in the marketplace.
Thanks. That was a good one.
Any questions coming from our viewers?
Yeah, I guess we didn't open it up. So for anybody who has some questions, just on the bottom of your screen there's a chat button. You can type your question in, and we'll relay that to Jeff and get you an answer. But I'll carry on with a couple of things here. When you talk a long-term return on, say, a bond fund, how much of the composition of the average return is yield, and how much is capital appreciation or capital gain?
Yeah, so that's a good question. That's one we get often. If you look at what your future expected return will be on a bond, absent default, of course, then yield is a very, very good proxy. But yield is measured over a long period of time. And let me give you an example. So let's say today you bought an investment grade bond to a company like, T-Mobile. So you bought a T-Mobile bond, and let's say it has a 5% yield and it's got a 10-year maturity. That 5% yield will be very close to what you will actually earn, absent default, over that 10-year period. But that return is expected to be in your minds and on a yield calculation is expected to be linear, right? That you expect to get this 5% over time. It doesn't happen that way. It's usually like this. And that is why if you reduce your hold period, you might have a different result than your yield. But if you held it over a long period of time, your yield is the best predictor of return. And so that number I gave you for the broad bond market of a 5% return since 1990 on an annualized basis, so every year 5%, that type of a return comes predominantly from yield.
Okay, so just a second question on that then. Obviously, if you're comparing the performance of managers and their abilities, a lot of it has to do with, well, their credit selection and their yield, which yield they go for duration, but obviously some capital appreciation. I mean, obviously there's times that there's an opportunity to buy something, just like you said, bonds act just like stocks. There's a bid and an ask, and you make your way by grabbing something when there's a sale, I guess, per se. So when you're saying that your yield is probably a good indicator of what the long-term return on a bond will be, some managers like yourself will improve your overall performance of your fund by gaining on the capital side. You would have a net capital return over the long term on a bond fund. Are you saying you get some right, you get some wrong, but the yield is the end result, or you say there's some gain in there?
No, I mean, if we're running a portfolio of bonds, we will be selling some that will generate some capital appreciation, and we will be trying to let me answer it a different way. There are ways in which we can try to beat yield. An active manager can try to beat yield in a number of ways. One, they can kind of pick the level of interest rate sensitivity they want in their portfolio. And I'll give you an example of that. Imagine if we owned a 10-year bond when interest rates were 2%. And then all of a sudden, interest rates went from 2% to 0.5%, right? That 150 basis point drop, 1.5% drop in yield translates probably to a 14% return. So if you positioned right and your portfolio had a lot of duration or interest rate sensitivity in a market where interest rates fell, you can generate a lot of capital gain on top of your yield. But if you held that bond over a long period of time to maturity, yield is your best predictive return. But active management matters here. What if you're right now, our funds have, our investment grade fund has 22% exposure to floating rate assets. Why does that make sense? Because if your benchmark or if your broad ETF doesn't have any exposure to floating rate instruments, it's probably not going to do as well as a mandate with floating rate instruments. So having a manager having the ability to move around, you can certainly generate alpha.
Okay.
One other question here, Jeff. In what economic environment, you've mentioned that bank loans are where you would be positioning clients' money right now to take advantage of floating rates and rising interest rates. In what environment do loans look less attractive? Obviously, in a dropping rate environment, is it that simple?
Yeah, I think in a period where default risk is high and the economy is incredibly weak, I think you will probably do better on a relative basis in a long duration or a heavy interest rate sensitive fixed income investment to take advantage of the price appreciation you'll get as interest rates decline. So I think that would be one environment. But what I really like about bank loans is, and this is an important takeaway for your investors, this is an asset class, which is not small, right? 1.5 trillion US is a pretty big asset class. When you consider, I'll give you context. The Canadian corporate bond market is nowhere near 1.5 trillion. So this is a huge asset class. In this huge asset class, it's only had negative returns in 2 calendar years, 2008 and I believe 2015. Every other year, the asset class printed a positive return. I think investors should have within their portfolio some fixed income instruments where you have that kind of profile, where you have such consistency of return, because loans return most of what they generate through coupon payments or interest payments.
Right.
Okay. You said back earlier that 5% average return since 1990. Is that something, we're looking at a kind of a 30-year period. Is that still kind of a long-term consensus that that's the normal range and that's what you would see going forward? And I'm not going to say tell us the average return for the next 30 years, but where's your sense of that?
It's a hard question to answer, Dave, because I don't know really what we've had is over that 30-year period of time, we really have had interest rates start to fall, really fall. So if interest rates have fallen, and right now a 10-year bond is probably, a 10-year treasury is somewhere around 290 basis points or 2.9%, it's hard to believe that you're going to have a 5% return if you held a government bond, because the yield is certainly not there. So I think we have to all accept. So if bond returns are going to be lower, you have to believe over time equity returns are lower as well, absent active managers, of course. This is at the index level, or what the asset class in general can return.
Perfect. And one other question here: how much increase in borrowing costs Canadians / maybe Americans are different. How much do you think they can tolerate before we start seeing defaults and some issues there?
Great question. Hard one to answer. I think that I think that's a hard one to answer, because the futures market, the interest rate market right now is pricing in about 9 additional interest rate increases of 25 basis points for the balance of 2022. That would put the overnight rate, which is the front end, at about 2.5%. 2.5% rate on the overnight rate means that if you're borrowing like a 5-year, 10-year basis or 30-year basis, it'll be much higher than 2.5%. How much can they actually withstand before it becomes a problem? I think that really depends on what the job market looks like. Because one of the things that's happening right now because of inflation, and this is where some people are concerned about controlling inflation and the Fed's ability to do that. Wage inflation is pretty high right now. Wages are going up, and that's a good thing. It's a good thing because people are getting paid more. But wage inflation is something that companies are going to have to deal with on a go-forward basis. So to answer your question about potential, like how much can they actually withstand, I think there's so many factors to consider, such as how much are people going to be paid more because of this wage inflation? How robust is the job market? And I think that will dictate how long they can actually go. But it has to be a concern for people now as you look at the housing market. And I'll never bet against the Canadian housing market because it's been unbelievable. Okay, so I'm never going to bet against it, but you have to believe that borrowing costs have to impact that market to some extent because mortgages are going up, and they have been.
So, yeah, that leads to a question that's maybe a little unrelated to fixed income. On the housing front, what is the solution in your mind to manage the housing problem?
In my mind, it's you have to speed up policy in order to build more homes. We just cannot take on the population growth through, a lot of it's through immigration at this stage and then having the amount of international students that we have. I don't think that we can service them with the housing stock that's in place and the housing stock that's going to be created. I think you have to increase that housing stock, and a lot of it starts with getting permits and the ability for builders to build homes quicker. And I think that's why the Canadian market has been so robust, even against other nations.
Yeah. Well, I think that you hit it dead on. I mean, it's not like we don't have a whole bunch of home builders and developers that are not eager to build more. I think you can only do so much within the terms of zoning and all sorts of things. But nobody wants that change either. Once everybody's settled into their neighborhoods, they don't want somebody who can build a back lane house and resell it, or split your lot in two, or knock your house down and build a fourplex. I mean, everybody's completely against any change in their neighborhood once they've settled in. And that's tough because you can only spread out so far too. I mean, we're just burning up farmland and you have to build roads and everything. It's just it's a big problem. So housing stock is key. If you can increase the housing stock, and I think that'll get somewhere.
I agree.
So yeah, other than the fight I had with my dad over it, mine was, imply some taxation on these properties. And I don't mean going after a gain on, say, your principal residence. Mine is more in the kind of the investment world. We issue a T5008 for every transaction on a non-registered portfolio, and CRA is aware that something's happened. So they'll check your return to see if you've reported a gain or a loss for that transaction. But we don't have the same in our real estate market. We need a T5009. I'm making up a number here, but for every transaction that happens, there should be some slip that notifies that someone disposed of an asset. And those are big assets. Those aren't $10,000 stock trades. These are $1 million housing trades. So I think that could help, but it's probably not as prevalent as supply and the stock. Obviously, taxation would only curb some people if it impacts their rate of return, but and speculation, I'm sure, is not even as rampant as we think. We just don't have a supply. We have a supply problem.
Yeah, but I don't think we have the data also on what's happening in the, having a beneficial owner registry, things like that in the housing market. I think will all help on the peripheral. But yeah, it all starts, I think, with housing stock.
Yeah, for sure. You got any other questions? There's nothing. We got one popped up here. I better get that in for. So here we go. Question: I own my home. I have no debt other than the cost of living. And let's say I have $1 million invested. I'm living off the yield that money invested created, but now that's not the case. So, with a lower yield, do I stay strong and ride out the wave and draw from the money that's in my investments and hope for a recovery, or consider being employed again?
That's a really tough question. That's why when we run money, we manage money on behalf of firms like that you guys are running. So you can answer these tougher questions more so than us.
You want us to answer the tough question?
Yeah, that's a really tough one. But I will say, look, having a diversified portfolio is very, very important. And having a portfolio with, on the equity side with some elements of dividends to give you current income, I think is important. But that is exactly what fixed income gives you, right? Fixed income gives you distributions and you get interest payment. Like our portfolios, we have a number of different loans in our portfolio, in our floating rate fund, for example. All of the interest payments made by the corporations get paid to our portfolio, and our portfolio, in fact, distributes that out to clients. So having those elements within your portfolio, so some dividend paying equities, some your fixed income that actually pays you as well. Those are the things that when you construct them, hopefully that kind of cash flow generation that comes out helps to service you along the way and helps you to hold on for a longer period of time. I don't know what that client's specific needs are, but certainly having a diversified portfolio is one of the most important things.
Yeah, and I would agree. Obviously, from an advisor side, it'd be nice if our value of our portfolios constantly were maintained or went up as we're in retirement. But really, for a lot of clients, you should expect that potentially your principal value of your investments might decline over your retirement period. When you're active and younger, you want to live off some of that money, and you can't expect sometimes to have saved enough for your portfolio to do that. If you have $1 million and you pass away in 15 years and your family has 500,000, that's not the worst thing in the world, because then your retirement is for retirement, not necessarily for an inheritance for anybody. But nobody likes a lower number on their statement than they've had previously, and it does invoke a bit of fear. Obviously 2008 and 9 was pretty good at showing that you had $1 million and now it's 700 grand, and your draw rate is probably a little heavier than 700,000 can support. So then you are forced into some decisions. Take more risk for a higher return, or maybe you do return to work and take a little bit less out.
Dave, think back to just what happened during the pandemic, right? Let's say you had $1 million account. At one point there, with the S&P and NASDAQ selling off between February and March, it went to 700,000 fast. And if you didn't stay, if you didn't have the staying power and you got really, really scared and you sold, you would have missed out on an enormous rally. Because again, as I said earlier, what happened was the central bank stepped in fast and hard, pushed down interest rates significantly, and that market came back very, very fast. Yeah. Right. And so that's just, things to be mindful of.
And I think, in that situation, I don't think most people expected that fast reaction. Yeah. I think everybody was in, what is happening out there? Like, what's going to be the result, the whole thing. And I think that fast reaction did change. That was 3 weeks of what I think we tumbled for 3 weeks or 2.5 weeks. Yeah. And it was over. You hit your bottom spot and it was upwards from that point. So
that's right.
The Fed has a lot of power.
When you decline interest rates, the magnitude that they did, it has implications on risk assets, and that risk assets go up.
Yeah, for sure. Well, let's see if we got another one popped up here. I think we're getting close. Nope, that's the same one. So we're good.
Well, that's great, Jeff. I think we've pretty much used up most of the time you allocated for us today. And we wanted to take just a minute here to thank you very much for sharing your thoughts with us. It was very insightful, and hopefully our viewers enjoyed it as well, because I know we sure did. And just a quick housekeeping item to our viewers. We will have a brief, I believe we have one set up to go out, Dave, after this wraps up. A brief
it'll pop up when we end this. Yep.
It'll pop up, so please answer the questionnaire. It's really just constructive feedback for us and how we run these things. So again, Jeff, thanks very much for joining us. Hopefully we'll be able to have you on here again someday.
Would love to. Thanks a lot, guys. Thanks for the opportunity.
You're welcome.
Thanks, Jeff.